Hello everybody and welcome to the Cyclical Investors Club YouTube channel. My name's Corey Kramer. Today we're going to be taking a pretty quick look at Charter Communications stock. Had a request for this one a while back down in the comments section. If you have a request of a stock you'd like me to analyze on the channel, just drop that request down in the comments and I'll get it on the whiteboard behind me. I'm working through these pretty quickly now. And eventually I'll make a video. If it's a stock that's in the S&P 500 like Charter Communications is, I post those on YouTube for free, and the rest I post over on Patreon, which is $5 a month at the basic level over there. So this is going to be actually be just a pretty quick video about, because I don't actually even track Charter. If you watch my other videos, a lot of times you'll see me go into my spreadsheet, and for most stocks that I make videos of on the channel, I have the numbers and everything kind of run over there for them. But the reason Charter isn't in there and why I'm not particularly interested in buying it is the main reason is you can see that when we look at the data on the fast graph, it only goes back to 2009. So we've never seen like what this business has actually done during a real recession. Usually, unless it's like a growth business or a new business that might fit my growth strategy, I just avoid these. So that's the simple explanation by why I don't track it and why I'm not really paying much attention to it. But I will offer just a little bit of commentary. This dark green area on the fast graph here is their adjusted earnings per share. You can see that they started making money back in like 2016, and they were growing very quickly. During this time, let's shorten this fast graph a little bit. Maybe we'll just go here. This might be one where we throw up the normal PE. So, well, that doesn't do much for us here. But we can just look at it. I can kind of cursor over. So we have a very high PE here, but once they start growing, you're looking at like a 60 PE for the adjusted earnings. But you can see the earnings are growing very quickly, over 100%, 50, probably averaged like 50% growth all the way until 2022. So the earnings, like right in here, had kind of caught up, sort of, maybe by right here, had caught up to the high valuation. But the problem is that that earnings growth has stopped, basically. So, and when you have a high valuation and you have earnings growth that goes from 50% a year to minus 2%, which is what they earned last year, and only expected to be single digits basically from here on out by analysts, which you can see down here on the fast graph, 7%, 2%. Now, the PE is quite low, but they also have quite a lot of debt. So, you know, it really, if you doubled that PE, it would be like 18 PE with, we'll just call it 7% growth. I mean, that's not such a great deal. So I think the market probably has this priced about right, even though it looks kind of cheap on the fast graph. But the thing that I would watch the most, because this is like a cable company, is the 3-year revenue, the revenue trend. So I don't have it pulled up right here, but I took a look at it before I decided to make this video. And so if you take the cumulative revenue over the past 3 years, it's only been like 12%. So that's about 4%, a little under 4% a year, actually. That's the rate of inflation. So basically for the past 3 years, which is when we've seen the stock price tank, how far down is it anyway? It looks really bad, but sometimes it's deceiving. Yeah, it is really bad. It's down 65%. Revenue growth has basically been flat. And if you think about like cable companies and things like that, even internet, like basic internet, the outlook does not look good for growth for them. So I think this is pretty much an avoid for me. I mean, it's always been an avoid, but now you can actually see the negative catalysts or the negative competition and so forth that are there. And since when you have debt on top of that, that makes it even riskier. and that's where we get the valuation that we have today. And it just doesn't look particularly cheap. It looks valued about kind of the rest of the market if you took everything into consideration and you assumed kind of very slow growth. But honestly, there is, a risk that they don't really grow at all, and they could shrink. So I mean, it would almost be like a turnaround play. Do they even pay a dividend? I don't think. So they don't even pay a dividend. There's like no insurance coming back to you. This one's just a pretty easy avoid for me. So that's my thoughts on Charter. Good luck to anybody who owns it or has already bought it. If you found this useful, hit the subscribe button, hit the like button, and I'll see everybody later. Bye.